Hi, everybody. Welcome to this webinar brought to you by Bursa Malaysia and managed by our company LifeChamp. Our webinar title today is Spotting Market Anomalies: How Behavioral Economics Impacts Investment Decisions. So, my name is Shen Chu. I'm the moderator for this session. Now, in this session, we're going to dive into the psychological biases that influence investors' behavior and make us make irrational investment decisions. So, we're going to study how do we avoid all these behavioral biases so that we can make better informed investment decisions. So, to begin with, let me just talk a little bit about disclaimer. So, whatever we share in this session is only for educational purpose. In no way that we give any recommendation for you to buy or sell any listed securities that we mentioned here. If you decide to make any investment decision, you're solely responsible for all your investment risk. Now, allow me to briefly introduce our speaker today. He graduated with a bachelor degree in finance from Coventry University, UK. He's a licensed financial planner and also a financial advisor representative licensed by Bank Negara. So he's a co-founder of EE Cameron, in which he shares content of more than 1 million views. He has more than 12 years of investment experience and have trained more than 1,210 working adults to master the wealth growth strategy in 3 years. So he's none other than Mr. George Paul. George, how are you today?
Hi, Shane, and hi to all our participants here today. Welcome and good evening to everyone.
Fantastic. So I will just hand over the session to you. I can't wait to learn from you about behavioral finance.
All right, thank you, Shane, and good evening, everyone. Can everyone see my screen here? Okay, I believe you can, right? Okay. Now, wait, hold on. Okay. Now everyone can see my screen. If you can see it, please type in a yes for me. Can I? Can I have some response from all our participants today, attendees today, right? Okay. All right. Good. Thank you very much. Thank you, everyone. So I will just, just skip through all the disclaimers and the introduction of myself. Some of you have met me more than one times, in this Bursa Malaysian Equities webinar. So let me just quickly go through with what you are going to learn today. All right, in our topic now. Let me just go back to the topic again. Right. So our topic today is how to spot the market anomalies. Right. So what is market anomalies? You want to know, right? Yes, this sounds so technical, right? So how behavioral economics actually impacts our investment decisions. Now, when we talk about behavioral economics, okay, we can break it down into two things. One is behavioral, one is economics. So in investment, often people talk about, hey, I look at this economic data, I look at that economic data, and you will feel that, hey, why the market doesn't move exactly like the economic data? Because they are behavioral effect, on our performance of the investment on the equity markets. See, so today I'm going to dive into this thing, and please bear with me because I'm going to share with you some of the items here. First thing, I'm going to teach you how to recognize some common behavioral biases in investing. They will lead to irrational decisions you will make in your investment. Okay, now this is the first thing. Okay, now secondly, I also have to identify specific market anomalies that emerge due to some aggregated investor behavior. Now, because of all of us, because of all of us, we have our very own investment behavior. Now, because of that, when we gather a lot of people that have the same kind of behavior, it creates the market anomalies, right? What we call is that it is something abnormal in the market, right? Thirdly, how to apply some practical strategies to reduce the impact of all these cognitive biases on our investment behaviors or the decisions that you make. Now, let me just do you one more disclaimer, apart from the disclaimer that the booster have to make, right? Today's topic is going to be a very technical one because I'm going to talk about some behavioral terms, and this, but you don't think that, oh, this is so technical that I can't read because this is exactly 99% of the retail investor will make. You see, every one of us, we will make this kind of mistakes or behavioral response to the market. and that will cause our investment decisions to be different, and that will cause the market to fluctuate and volatile. Okay, so I try to link it this way for you so that you know what will happen if I don't learn about it. Okay, now, so the first topic I'm going to share with you today is the introduction to behavioral finance first. Okay, now before I go into this all these things, let me just ask you a question. You just answer me if it's a yes or no, right? Okay. Don't come with a yes or no, lah. Because I just ask you to type in yes, right? Give me with numbers. Do you think that your emotional or your feeling are affecting your investment decision? If you think yes, you put in a one. If you think you are very you're very your emotion doesn't rules you. When you do the investment decision, you based on facts and figures. You don't actually think of put one idea. I haven't said zero. If you don't think that if you think that you are not using your emotion, put zero for me. See, everyone put one already. I haven't tell you the other version of it. Okay, so I can assume all of you actually admit that somehow your emotions and feelings will kick in, when you do the investment decision, right? Now, this is the reality. But okay, now let me drop it. Okay, now this is a picture I actually wanted to show with you. When rationality meets reality. Now, this is the brain of every human being. This is not the brain of mine. This is the brain of every human being. And do you know that, okay, our brain, we have a left brain and also the right brain, right? Okay, now, these two brains, they function differently. One part is a very rational one. They do decision and they think logically based on facts and figures. Now, the another part, the colorful one, right? These are the emotional side of our brain. So what will cause these brains to activate it? What will activate this brain is when we are happy, when we are getting something that we're very excited. Then our colorful brain, will start to activate it and then kicks in, and this is where the emotion come in. Now, when I talk about happy, excited, these are all the positive ones. But people, we as a human being, we have a negative this kind of emotion, right? Sometimes we feel sad, sometimes we feel negative. And that will also activate this brain to start to think about negative things. See, so when you see this is the human brain, and when we want to talk about finance, do you think that when we do all the investment decisions, you only activate your left brain, the one that the rational one, or do you think both brains will kick in? Based on your answers, I know both both sides of our brains will kick in. That's why a lot of us we do investment decision based on the emotions, and somehow your left brain, the rational one, doesn't activate more because maybe some of us we don't like to do research. We don't look at facts and figures. We only based on the emotion. So the colorful brain will kick in more. See, so what I want to emphasize here is that finance is not just about numbers. It is about people, because everyone we have these brains. So, and people are emotional. You see, all of us here, I don't see a zero in my comment session just now. That means all of you, I can say maybe the 90%, I don't quote it 100%, but maybe 90% of you actually think that your emotion, your bias actually drive your investment decision. Now, when you think all the retail investors in the market, if everyone are just like the sample size that we have today here, what do you think will be with the market? Right. So this will cause inconsistency, and this is what we call the behavioral finance. Okay. Now let me just show you a little bit. We have a traditional finance and also we have the behavioral finance. Now, in the traditional finance, we assume that we are like a calculator. We are always the rational, logical kind of people. The market are very efficient, when you study economics, then you will study all this. Now, but in other side, in reality, now the left-hand side, the behavioral finance is the reality. Everyone, we are just like a storytellers. We are emotionals. Our mental shortcuts will influence ourselves to what to buy, what to sell in the market, and how we react to the news that just came out from the newspaper. So in the reality, we often see there are a lot of emotional investors, and markets are sometimes inefficient. We always say, hey, nowadays all the news are very fast, so the market is very efficient. But somehow it is not a very true statement because of the emotion element of the investors. So when emotional comes in, everyone just act based on fear or greed, and that's how we have the fear and greed index, the indicator by CNN, right? Now this is what I want to show to you, because in theory, in paper, every one of us want to shift to the left hand side, the rational investor, the efficient market, right? We use available information, we use facts and figures, to do decision. But in reality, everyone are at the right hand side. Do you see the imbalances in this thing? Right? But why? Why all the investors are not always rational? Okay. Why? Just now I asked you all, right? You all say, oh, feelings, emotion. But why? Okay. Why? Let me show you. First thing, okay, FOMO. Good. FOMO is one of it. Thank you. Okay. Fok Weng, right? Thank you. First thing first, because real life decisions are often made under uncertainty and not perfect information. Like I give you an example, okay, a very recent example. When Donald Trump announced the reciprocal tariff on the 2nd of April, when we received this kind of information, what happened to the market? Any one of you can guess what happened to the market if you don't read the paper. But I believe everyone of you experienced it, right? The market went down. And it's not went down by 1%, by 2%. It went up a lot, right? Because what? When the news first came out, you see, when Donald Trump come in and he give the reciprocal tariff, it's all about numbers, right? Oh, Malaysian, I charge you 24%. Oh, Vietnam, I charge you 40%, right? Yes, he called it a liberation day. But when you see, these are not the perfect information because we only look at the number. Do you know how much that we were lost in the trade imbalances between US and Malaysian based on that 24%? Any one of you know, right? At that moment of time, we don't really know, right? We don't know. But we just based on that uncertainty, we make up our decision. Oh no, this is gonna be a bad market. So everyone go and sell down the market. That's why the market dropped without everyone going to study on it, right? Let me give you a second example. After the 9th of April, Donald Trump decided to say, "Oh, let's give it a pause, right? Let's on hold all the these tariff implementation, right?" What happened to the market? See, we have been experiencing it in the past 2 weeks, 3 weeks. What happened to the market? The market just went up, right? The past 1 month, the market just went up like nothing happened. See, but do you know when he called pause, he on hold all these things? Do you know what will happen? We don't know, right? But the market just went up like that. Now, this is what happened, when we are in the market. So, because in real life, we don't make decisions based on the perfect information. And we can also admit that not all the information that presented to us are perfect one. So we often make decisions based on the information that are given to us. Now, this is the first thing. Secondly, because of fear and greed, right? Fok Weng just now mentioned, FOMO, right? That one is also one of the greed or the fear that kicks in. And sometimes, and most of the time, when we do decision, these are stress distorted kind of a decision. Because we are under a stress situation. And thirdly, cognitive limitation, which cause us to make mistakes, even we don't really want to make that kind of mistake. Why? Because we skip analysis when we are in panic. And when we have been panic, we just follow others. People sell down. You see, oh, everyone is sell down. Let me just also sell all my stock. So you just follow others without you go and really think about, hey, what happened to the market, right? And sometimes because of the fear, people just avoid selling the losers. They don't want to become the last one to sell. So they all sell because what? Everyone just fear that they are the last person to sell, right? Then they will be the loser. They will be the failure. So these are the patterns that we are actually seeing in the market. And because a lot of people are doing it, it's not just a mistake, you see. It is a pattern and it's a forming a market anomaly because of this. So let me just share with you the foundation of behavioral finance. This is what we call a prospect theory. Now, some of you, if you study, if you read books, then you will know about this. But if you are not, let me just briefly share with you what is this prospect theory. Now, this theory is actually brought up by this Nobel Prize winners, Daniel Kahneman and also Amos Tversky. Daniel Kahneman just passed away not long ago. And what they mentioned here is that people are not equally sensitive to gain and losses. What does it mean? Losing 100 ringgit will hurt you more than gaining 100 ringgit. Okay. Now this explains why when the market sell out, everyone just sell it. From this theory, you might not understand it, right? Let me give you an example. Okay, everyone, let me give you an example. Two scenario. Give me your answer. Okay. Now, a scenario one, you have received 1,000 ringgit, and now you must choose between option one to keep 500 ringgit for sure, or second option, 50% chance to keep the 1,000 ringgit and 50% chance to keep nothing. Which option you will go? Give me your answer. One or two? One or two. Which answer you will go? Do you have a 100% sure you will get 500 ringgit? Or the second option, you only have a 50% chance to keep it, and 50% you will lose nothing. Everyone give you option number one. See? Now let me give you another scenario. Okay. Now you have received 1,000 ringgit, and you have to choose between option number one, you are going to lose this 500 ringgit for sure. And second option, you are going to lose 1,000 in 50% chance, or 50% chance you will lose nothing. Now, in this circumstances, which option you will choose? One or two? Okay. One or two? Now, see? Okay. Now, in scenario A, I can say every one of you choose option number one. Now, this shows us the risk aversion when we face the gain, you see? Because for human being, we prefer sure gain rather than just gamble and, I expect the value is just the same because 50% chance I can keep it, but 50% chance I will lose. So in these circumstances, everyone just become risk aversion. They don't want to take risk. But in scenario B, most of you choose option two. Why? You see, you are the same kind of people now. When scenario A and B are still still the one of you are doing the decision. But why suddenly in scenario B, every one of you become a risk-seeking behavior? Do you know why? Do you know why? Let me tell you why. Now, this is the prospect theory. This is the prospect theory. Because people, we are not rational in making choices. So you see, why in scenario number A, you choose option one? Because the pain of you losing this 500 ringgit, okay, feels more. You see? So you think that, okay, let me just keep 500. I don't want to waste this chance to have a chance to lose 1,000 ringgit. Because the 1,000 ringgit losses is huge than the 500 ringgit losses. So at this moment, you rather choose option number one. But in option number two, because you know you sure will lose 500 ringgit already. So instead of just pay that losses of 500 ringgit, you wanted to gamble against it because you don't want to lose this 500 ringgit. This is prospect theory. Okay, this is prospect theory now. It's not only you. If you take this scenario, go and ask everybody among yourself, among your friends, families, they will give you the same answer I share with you, because this is what we call the prospect theory. Okay, when we are facing losses, we feel painful, so we don't want. But we for sure will lose this thing. We will start to gamble. Now, this is human. Okay, so this can also explain to you why some of the investors hold on to their losing stock. Now, let me ask you, how many of you actually, when your stock is in losing situation, you don't sell it, you rather hold it? How many of you do that? Just admit it, you say me. Put down in the comment, put me. How many of you actually do that? When you have stocks that are in losses, unrealized paper losses. Okay, I can say every one of you, including me myself, I also do that mistakes, when I was young, when I just started my investment. Because you see, why we want to hold on to the losing stock? Because for us, it is unrealized losses. We still wanting, the pain of losing the money is very painful. So we don't want to cut loss. We always think that, okay lah, the market is going to come back one, right? And this is what happened to everybody, all the retail investor. You see, many of you give me the answer, me, right? That's the reason. That's the reason. So, you see, in stock A, when you have 20% profit, you will often go and sell it already, right? You say, wow, 20% profit, I'd rather sell it. But you see, when you are in 30% losses, you refuse to sell. Why? Because of the theory prospect. Loss is painful than the gain. Loss is painful than the gain. Now, this one I mentioned about stock, not the entire market, because sometimes the stock drop is not because of the market condition. It's because the fundamental of the stock is really wrong. So it went down. Right? The fundamental is deteriorating, so it went down. Now, this is what we call the loss aversion. See? So if you understand now over here, now, right? I think after I have shared the past few slides, you have started to understand the human behaviors, right? You started to understand yourself. See? Agree, yeah? Any one of you agree? You started to understand yourself. Yes or no? Yes or no? Right? We started to understand ourselves more. Now, when we understand ourselves more, we will now start to understand the market, right? You see, the market is consists of what? Emotion, money, and decision. Okay, sorry. Okay, so the market is consists of emotions, money, and decisions, and it forms the market behavior. Okay, because of all these three things, it become and form the market behavior. So understanding all these biases, won't make you perfect, because if you understand it, you think that, oh, I will not, I will not make this kind of mistake. But no, we just want to let you know that this is the market. Okay, whether you understand or you don't understand it, the market is like this. But it makes us more aware of it, because you see, with or without your awareness of your emotion, you will still make the decision. The retail investor in the market will still make the decision. But if you are aware of it, you can make a better decision. And awareness, let me tell you, awareness is the first line of defense against all the emotional mistakes that we will make in our investment. Remember my quote, awareness is the first line of defense against all the emotional mistakes that we will make in the market, right? Now, all good? Now, if all good, let me just goes faster to our chapter 2 about the behavioral biases in investing. Okay, now, this is what going on in our minds when we do investment. Fear, hope, greed, despair, everything just came up. So in these sessions, we actually wanted to explore to you the invisible forces. They shape our investment behavior. Just now we already understand the market. We understand that behaviors, emotions is going to form the market behaviors. Now in this part, I will just go deeper into what are the behavioral biases. Okay, now first thing, what are the biases? Now, biases are the shortcuts that can lead us to a costly mistake. Okay, and they are the mental shortcuts that save us effort, but these often lead us to a wrong decisions and conclusion. And in investing, these will distort our risk perceptions, timing, and also decision making. But okay, one thing, but these are not the weaknesses, because this is the natural uh cognitive tendencies that we will have. So we just need to aware of it. But this is not something of our weaknesses, because everyone will have this kind of biases. Just that you aware or you don't. See, okay. This is the example I want to show you. Now, some of the investor, they'll say, hey, just jump down here. This is a faster way. But there is another way. It's not faster, but it's safer. So some people, if you don't really understand or aware of your behavior, people say, hey, this is the faster one, you jump. Then we just jump off the cliff. But if let's say you make decision, a rational one, you're aware that, oh, this is just emotional, this is just behavioral biases. Let me just look around first. Oh, I see there is a better way with lesser risk. Then you choose that risk. Then you choose the route to go down the hill, right? So this is what I wanted to share with you. Now, next, I will go on with the 5 behavioral biases. They will influence our investment. Okay. Be engaged, be participative with me, because I'm going to share something that every one of us will face, and we will have this kind of behavioral finance bias when we do our investment decision. First thing, overconfident bias. Okay, I will go and I'll explain it later. Secondly, is what we call the loss aversion. Thirdly, anchoring bias. Fourth, confirmation bias. And last but not least is the herding behavior. Okay, 1, 2, 3, 4, 5, total of 5. Let me go start with the overconfidence bias. How many of you think that you are overconfident bias? You have this kind of bias when you do investment? Give me one. If you think you have this overconfidence bias, put 1 for me. Okay. Let me see how many of you actually have this kind of bias and you aware of it. I haven't explained to you, I haven't explained to you. But let me just see how many of you think that you are. Okay. All right. Oh, okay. Not many, not a lot, but it's okay. Still a handful of people. But first thing, overconfidence bias is actually overestimating your ability. Now, in investment, overestimating your abilities equal to overexposure to risk. Okay, remember this. And because why? Because people believe that they know more than they actually do. Huh? We often think that, hey, we actually know more about this company, but you don't. Let me show you some signs of overconfidence. Okay, first, if you are a trader or you are investor, you have a frequent trading, but these are all based on prediction. You are too overconfident and you based on prediction, you think, I'm very right about this. Okay. So you make the trade. Or secondly, most of the people, they ignore the professional advice or the research by the professional. You see, Bursa, Malaysia, right? And all the other trading or participating organization, all the brokers, they will have research report. Somehow, some people, they don't agree with it, right? They don't agree. Hey, yeah, these are all lousy research. So they do their own investment decision. Now, this is what we call sometimes it is overconfidence. But yes, if you read the research and you done yourself, your own research, and you do comparison, okay, and that's what you might not be overconfident because you know what you're doing. But most of the people, they don't. They read it, they think, this is not a good report. They dump it, right? Then this is not right. And one belief that I often tell people, you cannot have this kind of belief that you always think that you can beat the market. Please don't. Okay. Please don't have this kind of mindset, because the market will always beat you. So don't think that you can beat the market. Just right with the market will do. See, We don't want to beat the market because market is doing very well. Last year, Malaysia KLCI index giving us about more than 12% return. Why we want to beat the market? 12% a year is considered a very good return, right? Most of us, we don't make it, right? But the KLCI index can make it, right? So let me give you some examples. During the bull runs in 2020, 2021, you see, retail investors just buy a lot, just buy without buying the fundamentals. That's why during that time, a lot of stocks just went up without the fundamentals. This is what we call the overconfidence because they think they know the market, they want to beat the market, and they go and do it, right? And sometimes the second example, traders they ignore to stop loss because they think that I'm sure this will rebound. When you think that this will rebound, you're overconfident because the market tell you otherwise. And let me share with you, overconfidence is very dangerous because it gives you a false security. You think you are safe, but you are not. So it will lead to what? Over trading, under diversification, and a lot of painful lessons that you will make. Okay. So please, if you're aware of it, you need to tone it down. Okay. We need to find ways or methods to actually tone it down or control our overconfidence bias. Right. Now, secondly, I go to the second bias that we will make, loss aversion. Now, this is what we mentioned just now at the prospect theory. The pain of losing is twice as strong as the joy of winning. That means we don't like the feeling or emotion of lost money, right? And based on the prospect theory, investors hold on to losing stocks just to avoid realizing the loss. See, so let me give you an example. Yeah, some people or maybe one of you, you will say, "Hey, I will just wait until this stock goes back to my entry price." When the price drops 20%, 30%, 40%, you will tell yourself this, hey, I will just wait until this stock goes back to my entry price. Now, secretly tell me, you don't put in the comment, or maybe you can put in the emoji, you can emotion. You just put good of a smiley face. How many of you actually tell yourself, or you have told yourself this before? You told yourself when the stock in losses, you say, yeah, I will just wait until this stock goes back to my entry price. How many of you have done it? Hey, don't let us know lah. Don't let us know. Just put in the emotion will do. Just put in the emotion. Yes, smiley face, that face, okay. No need to tell us one. No need to tell us. Okay? Because everyone happened. This happened to everyone. Right? Now, thirdly, is what we call the anchoring bias. Okay? Now, anchoring bias is what it means. We are relying on irrelevant reference point when we do investment. Okay, we anchor to something. For example, you bought the share as at 5 ringgit. Okay, at 5 ringgit, and the price just dropped maybe to 4 ringgit, to 3 ringgit, and you will anchor yourself to that 5 ringgit. You say, hey, I wanted the price to go back that kind of point, then only I sell it. This is what we call the anchoring bias. And sometimes people don't anchor on the purchase price, they anchor on the previous stock high. Okay. And this will cause a bad timing for you to actually sell the stocks when it is time for you to sell it. Okay. Let me give you an example. Okay. Somebody say, hey, I bought this stock at 5 ringgit. It's now at 3 ringgit. I will wait it to go back to the price. But you think, when you anchor your investment decision based on the price itself, do you actually think that the company fundamentals, okay, of the stock itself will follow your anchor to the price? It will not, right? It will not, right? So your price and the fundamental of the company is actually not related. So you are not supposed to anchor your investment decision based on the price. You should anchor your investment decision based on the investment or the company's fundamentals, right? Now, this is anchoring bias. And let me tell you, anchoring bias is also very dangerous because your brain, okay, has been engineered to cling to the numbers. But this has no impact on the future values of the company. But emotionally, you will think that this number is very important, you know. And this happened to a lot of people because in the past I've talked to a lot of people, and then they will always tell me, "Hey, that price went up to 10 ringgit before. So what? The fundamental is not there. Why you are still holding on to stock, right?" Now, this is what we call anchoring bias. And fourth is the confirmation bias. Okay, now this confirmation bias is also very funny bias because people always seeking the only information that support their belief. When they show you the information against your understanding, you will ignore it. You will think that now this information is wrong. My information is correct. So when you do this, you are ignoring all the warnings, the red flags, and conflicting data. Okay, and even worse, this has been amplified by all the social medias. Okay, because nowadays we have a lot of social medias coming up and tell us things like this, like that. And some people just focus their bias onto some KOL, some bloggers without doing their own research. Okay, I can give you a real life example of myself. Back in 10 years ago, I invested in a stock. Okay, they are the world largest condo maker based in Malaysia. I don't say the company names. I invested in that stock. I believe in the management directions of what they wanted to achieve. Okay. And when the quarter report started to show the company's performance is dropping, is deteriorating, I always keep on telling myself, hey, you see, the management is still very positive on that. But actually, the papers on the finances, they already tell us this company is dropping. Their fundamentals has changed, right? But I always anchor myself. Hey, I don't only look at the confirmation one. The the bosses always say, they are doing something, they are doing something. You see, I ignore all the facts and figures. And you know what? The stock that I hold on to dropped more than 70%. And I have to cut all the losses. And it makes me 5-digit losses on that stocks itself. On one single stock, I have made 5-figure losses. Now, this is what happened to myself before I understand all these behavioral bias. See? Okay. Now, I think my example is better than this example. So I just move on to the last behavioral bias. It's what we call herding behavior. Okay. The herding behavior is like this. If everyone is doing it, should you do it? Should you do it? Right? Because herding behaviors is actually following the crowd without your own independent research. So what happened? It happened often during the bubbles, the panics, right? And examples, I have given a lot of examples just now, right? But let me give you another example. During the GameStop rally, this was happened in 2021 in US, in Americas. When this GameStop shoot up, everyone just right along the stocks. And a lot of retail investors actually lost their money and they went bankrupt because of this rally and because of the herding behavior. Now, this is very important, right? And we always, and I can say this is not wrong, see, because as a human being, we feel safer when we are part of a crowd, when we are in the biggest crowd, we feel safer. But we don't know whether the crowd will be running in the wrong direction or not. We don't know. So we need to do our own research. Okay? Right. Now, why all these bias matters? Why I share with you all these biases? Because these biases will lead us to over trading, miss out opportunity, holding on to the losses too long, or when sometimes we do panic selling at the bottoms. See, so the first step for us to break all these biases is to recognize it first. So whenever we want to do a decision, recognize and to identify whether you are make your decision is based on all these biases. Okay, because once you know all the trap, you can design your own strategy to avoid all these things. Right now, before I actually go to the chapter number 3 to share with you more, I want to see how many of you, okay, I have shared 5, right? 5 behavioral bias. How many of you, okay, you have more than 3? You think you have more than 3 behavioral bias that I shared just now? More than 3. Put on 3 for me. Okay, more than 3. How many of you have less than 3? Put 2. Okay, put number 2. How many of you? Okay. Okay, some of you more than 3, some less than 3. Okay, good, good. Okay, I can see balanced number here. Okay, a balanced number here. Some have more than 2, some have less than 2. Great. Now, and some of you who don't answer, I believe you have at least one. You have at least one. So what happened here? Okay, what I wanted to bring it up to you is that don't worry, because everyone have this kind of mistakes. So don't worry. Okay. But what happens is that always, always recognize and identify all the bias before you actually make the decision. Because once you identify it, you know whether your decision is based on bias or you have based on your independence resource. Okay. Now, if that, let me bring you to the real world market anomalies. Okay. That caused by all these behavioral biases. Okay. Now, okay, this is an example. Okay, this is an example of the Apple share price. Okay, Apple stock. Any one of you using Apple products, iPhone, iPad, uh, the earphone, what they call the i earpod. Okay, so sorry, I'm not a Apple fan, so I don't actually know about it. Like the MacBook and all that, right? Now, the iPod. Is it called the iPod? No, I don't think so. iPod is the MP3. Oh, Bahari, you have just show you have just disclose your age, man. iPods were a long time ago. That one was during my primary school. Just kidding with you, Bahari. Okay, now, now come back to this. Okay, you look at this chart, right? The blue color one, or you can call it the purple color one, is the share price movement of the Apple stock. And the yellow or the orange color is actually the earning per share, the performance of the share of Apple company. Now, based on this chart, okay, is a great example showing us that how behavior biases shape the market. See, because sometimes when the earning per share is not performing, but the share price is going up. See, the share price is going up at this level, right? Let me show you. This is my laser pointer. See, the earning per share is dropping, but the share price went up. The earning is not growing as much. Okay, see over here, the earning per share is not performing, but the share price went up like this. This is what we call the behavior shape the market. And this is what we call when the market is not always efficient. See? And what are market anomalies? Let me just quickly run through these some boring definitions. Anomalies are predictable market patterns, and it is not explained by the fundamentals, because just like what I showed you just now, Apple stock and stock price and the fund and the earning per share is not equally efficient, right? So why we have market anomalies is because of group behavior. You and all the investor, they made the same decision because of the behavioral bias, and that caused the market anomalies. And it was created by emotion, not by fundamentals. So what are the items? You have their earnings, the price, you see, emotions. So let me share with you some other market anomalies that are present and existed in the world, real world right now, because of the behavioral biases that all of us have it. Okay. Now the first thing is what we call the January effect. Okay. And let me share with you. This anomaly is not I plucked from the sky one. This is what actually really happened in the market. In January, okay, during January, from the history, we can see all the small cap stocks tend to rise tremendously. okay, tremendously in January itself. Why? Why? Because a lot of investors, they will sell in December to cover their tax losses. And then in January, they will rebuy the stock. Okay. You look at this at the US market, you will see it, right? And it is a psychological fresh start effect. Everyone will say, oh, January is the start of the year. So I wanted to buy more share. Yeah, this is my new year resolutions. I wanted to achieve this, that. Everyone do it at January. Okay. And what are the biases that related to all this January effect and cause it? Two things. First thing is the anchoring bias, because you have the idea last year this price performance is doing very good, so you have already anchored yourself to the performance. For example, you Bursa Malaysia KLCI last year went up 12.7%. Okay, so you have already anchored yourself to the 12.7%, and this year in 2025 you say, okay, so my target for KLCI this year is also 12.7%. So people will go and chase it. But then in the middle, they will started to have other biases coming in, or this Donald Trump issue, this tariff problem, and all that, right? And this will start to drop the market. But no, people don't care about it during the new year. Okay. And secondly, is the loss aversion, because uh people don't like to hold all their losses. Okay, during year end. Okay, maybe not you, but maybe a lot of people, they don't like it, so they will cut their losses on the December, and they rebuy it back in January. Okay, now this is what happened. Now this is the first market anomalies I wanted to share with you. Not not much of example in Malaysia, because these January effects often happen in the Western country. Okay, it often happen there, not really in Malaysia. Okay, now secondly is what we call the momentum anomaly. Okay, now the momentum anomaly means that the stocks that have gone up in the past 3 to 12 months will tend to keep rising in the short term. That means when the stock is in the momentum of growing up, it will high likely to keep rising in the short term. But all this momentum is not always tied to their fundamentals. Okay, this is just the market price performance, not their fundamentals. So this example, you can look back at in Malaysia context. Oftentimes, you will see a lot of stocks, their share price will go up a lot and in a long time, right? Maybe 3 months, 4 months, 6 months. But their fundamentals doesn't follow, right? What happened to this? Why this thing happened? Can anyone of you know what bias actually actually contributed to this momentum anomaly? Okay, let me give you and some homework to do. Okay, let me give you a test. What behavioral biases do you think that contributed to this momentum anomaly? Just now we have shared five, right? Five. Which one do you think have contributed to this momentum anomaly? Okay, Stan said four more. Who else? Herding bias. From Moody, thank you. Okay. Few said herding. Some said overconfidence. Okay. Let me disclose to you. The answer is herding behaviors. Yes. Four more. Yes. And also confirmation bias. Okay. Confirmation bias is happened because when the stock price went up, maybe in the last 3 months, it went up 20%. Okay. So you always look for the good news in the market to support yourself. You see, to continue ride the stock up. But the fundamental, you just ignore it. Right? So this contributed to the momentum anomaly. Overconfidence, somehow, yes, it will also contribute to this anomaly as well. Okay, so just some examples, tech stock in 2020, 2021, the fundamentals don't actually follow. But the tech stock just went up. The Magnificent Seven, right? Just went up. And most of the time, investors buy all these stocks. It's not because of the fundamental. It's because they think that, oh, because this stock go out, ma. So this is a good stock, so I go and buy, lor. Huh? This sound familiar to you or not? Does it sound familiar to you of my statement just now? I buy this stock because it is uptrend, ma. Everyone is buying it up, ma. So I also buy, lor. Correct, huh? This is what we call the herding behavior. I still can remember, last time, many years ago, I think it's before COVID-19, many years ago, there are some oil and gas company, I don't name it, there are some oil and gas company, where in the market, people are shouting, oh, this stock can went up to 10 ringgit, 20 ringgit. People are buying it because the stock price have been momentumly going up very strong. Then I asked all these people, hey, do you know this oil and gas company? Their margins, they're not very high, And do you see the Brent crude oil prices? They tell me, no, I just buy because it keep going up. I can make money from this. And you know what? This stock tanked until today. Eugene said he know which stock. I don't want to mention the name. You know. Uh, Not only this one. Not only this oil and gas stock. Many stock also happen like, especially the oil and gas stock during that period of time. I'm not saying that they are doing it now, but during that point of time. Okay. Now this is caused by the herding behavior. Okay. So we want to avoid it. We want to avoid it. Now, thirdly, the third anomaly is what we call the post-earning announcement drift. This sounds so technical. This is what we call PEAD. So when the company beats their earning, okay, somehow you don't see the share price jump up. Okay, you somehow don't see the price jump up. But it will take a few days for it to actually go up. Okay. Now, if the company's earning, okay, the company's earning is lower than the expectation, straight away you will see the stock price drop. Okay, right? Gap down. But if the earnings, okay, if the earnings exceeded the expectation, you don't see it gap up right away. You don't often see it. But somehow, yes, in Malaysia, yes, we somehow see it. But in the larger market, like for example, the US, somehow we don't really go and see it. Why? Because the market will always underreact initially, especially all the positive one. But the negative one, they'll react straight away. Yeah, they'll react straight away. Because now this is what happened, right? So what are the biases contributed to this? First thing are the anchoring bias, because people are anchoring to their previous performance. So when their earnings beat that, they'll think that this is normal. People will think this is normal. And secondly, it's because of the slow belief update. Sometimes maybe this person, they have a confirmation bias on that, oh, this stock is not doing well. Suddenly the earnings just beat the expectation. So this challenge their confirmation bias and contributed to this PEAD. Okay. Now, a few more. Okay, a few more. This is my fifth one. I think. Is this my fifth anomalies? 1, 2, 3, 4. Okay, yes, this is my fifth anomalies I wanted to share with you. And the last one, and the fifth, the fourth, and also the last one. It's called IPO mispricing. Okay. This happened in Malaysia quite a lot of times. IPO prices, somehow they were skyrocketed on day one, and then they will correct back. Okay, why all this happened? Because they are driven by all the media attention and also some speculative demand. Don't look at the IPO market today in 2025. Look at the IPO market in 2024. Then you will see this IPO mispricing market anomaly happen a lot. Because that time the market is doing very well. See, and because of that, people have the market is hype was over there, media attention is over there. Every time you see the IPO is oversubscribed by 50 times, 30 times, 100 times. See, now that's caused the market to have the speculative demand. So the share price will skyrocketed on day one, day two, day three. But throughout the year, you will see that coming back. Okay. Now, based on the data I have collected, in 2024, about a quarter of a stock will drop back, drop lower than their IPO price the whole year, a quarter of it. And you know what? This number jump up to 40 over percent. If you calculated their losses compared on the day one instead of the IPO prices. That means they jump up on the day one, but then they start to drop below their day one prices. This number shoot up to 40 over percent. That means almost half of a stock IPO in Malaysia last year, see last year in 2024, they don't survive after their day one. See, this is crazy, and this is the market anomaly because of what? Because of the speculative demand. People look at the news. Hey, this stock got oversubscribed by 100%. Oh. No, I will oversubscribe by 50 times. Oh. I cannot get the IPO ballot, or the public offering. I don't get it. What happened? Day one, everyone will go and buy, right? Everyone go and buy. And you drive the stock price to went up. Okay, you drive the stock to went up. After that, you suddenly believe, you suddenly become rational. Oh, actually, this is just the hype. Huh? This company, I don't like it. You dumb, no? Right? Huh? You dumb, no? And then the share prices drop. Like Leo say, like pump and dump. But this pump and dump is not by the operators. It's not by the market maker, This pump and dump is made by all the retail investors itself. So you pump the stock yourself, you dump the stock yourself. So you are the person. Yeah, you are the person that do all these things. So, okay, now this is what happened. This is what happened. Many people give you the emotion, the LOL emotion. Yes, exactly. This is what happened, right? And after I have shared with you all these anomalies, what they want to teach us, okay, let me share with you. Anomalies are a proof to us that psychology actually shapes our market, not the fundamentals, not the rational investor, but the psychological side that shapes our market. And these are mostly temporary and repeatable. And because of that, and because of these repeatable characters, we often can study the market. Right? We always can study the market. And how are we going to know all these anomalies? Because we study the market, we understand that now these are the top 5 biases that people have. And if this bias kicks in, these anomalies will happen. See, so we have the data, we understand it. So today, every one of you stay until now, you have recognizing it, and starting from today onwards, okay, I want you to be more cautious. Okay, be more cautious. Or if you are smarter enough, okay, or if you are smarter enough, you can capitalize this when people react accordingly. Okay, when people react accordingly. For example, when a share price drop a lot, panic selling, you don't tell it because you recognize it. And you see a lot of people panic selling, what can we do? If the stock is good, the fundamental have not changed, what we can do? We look for entry. Exactly. Thank you, Heng Yang. We look for entry. Right? We start to buy the stock at a cheaper price, at a bargain, right? At the sales. Okay, this is what Warren Buffett says. When the market is dropped, I come in to get the bargain sales. Right? So our goal today to spot all these anomalies is not to be a perfect investor, but for us to understand what will happen. Okay, pull yourself out of all this crowd and make your independent decision. Okay, so stay aware of how your own bias can make you part of the herd. Okay, now my last part of today, I want to share with you some strategies for you to overcome all these behavioral biases. Okay, these are what we call how to outsmart ourselves, to beat the bias, because these biases are hardwired into our thinking system already. So these are hardwired, but if you know the strategy, you can stop them. Okay, because these are your brain. They are the software inside your brain. What we can do, we upgrade our system. Right, from Windows 7, we upgrade to Windows 8. From Windows 8, we upgrade to Windows 10. Now Windows 10, we upgrade to Windows 11. Now, this is the same. After today's sharing, you upgrade your brand from the bias become to how to beat the bias. Okay, so now I want to share with you. Okay, and before I actually share with you the strategy, let me tell you why managing our bias is very critical and why does it matter. Okay, the first thing, market volatility isn't your biggest trade investment. Okay, you must understand this. The market volatility is not your biggest enemy. You yourself is your biggest enemy. See, your brand is your biggest enemy. You must understand this first. Okay. Secondly, emotional decision can sabotage your investment and the growth of your wealth. If you're a person that have gone through financial planners, they give you your investment plan, you have plans for your retirement, don't let emotional decision kick in and sabotage your wealth planning. This is very important. Okay. And the beauty part of it, the best investors, they don't remove their emotion. They play around with it and they plan the investment decision around it. Right? Now this is this. The market risk is what is obvious, but the behavioral risk is the biggest hidden risk that will sabotage your investment. Okay, right? Now let me share with you the strategy number one. Okay, I will go back into the strategy. Oh, by the way, if you have any question, put it down into the Q&A sessions or in the comment section because after my sharing later, we are going to pick up some questions to answer. Okay. Now, first thing, strategy number one, use an investment checklist. Okay. Create a checklist for yourself before you do investment. Now, I cannot give you a checklist. Why? Because I have my own style of investment. You have your own style of investment, but you need to make sure now, based on your own investment style, what are the things that you need to check before you do the investment? For example, for me, I need to evaluate the company fundamentals. So every time I study the fundamentals based on my BCDF formula, my bridge formula to understand the fundamentals, to calculate the valuation, that these are the things that I will do. But if you don't use the same formula like myself, you do based on your own investment strategy. Okay. And for example, if let's say you have the entry and exit criteria, also put it down into your investment checklist. So you must always take whether have you done your entry criteria, have this stock meet all these things? Okay, what are the exit criteria? Have this stock meet this before you actually sell the stock? You must always have this kind of checklist, right? These are some examples. Okay, and why we need to have this is because this will prevent us from impulsive buying or selling the stock based on panic selling. Okay, just like I give you an example, a lot of professionals in the market or as a career, they have checklists. For example, pilots. I just flew from KL today, this afternoon, from KL to Sabah, Kota Kinabalu, here. So I'm right now here in Kota Kinabalu. Do you think the pilot, okay, do you think the pilot, before they take off the plane, they will do a checklist? Do you think they do a checklist? Oh, tick, 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 tick. Okay, now this plane is safe to fly. Do you think they do all these things? 100%. They must do it. Am I right? Okay, you're right, the pilot must do. Now, when you walk into hospital, okay, you're going to do a surgical you're going into the surgical theater. Do you think the surgeons they also have a checklist? Now see, okay, Eugene said he worked in healthcare. Checklist is everything, right? You are in the surgical, you are the surgeon. Do you do the checklist? Now I want this knife, I don't know how to call it. I need all these tick, 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 tick. Sure. Now, and we can start our surgical now, right? But as an investor, do we have a checklist? How many of you have a checklist? You put in to me. You have a checklist, you put yes. You don't have a checklist, put no. How many of you have a checklist? Oh, good. Okay, some of you have it. Yes, quantitative and qualitative. Good. Okay, thank you, Eugene. Okay, Modi say you have your own checklist, but you don't use it sometimes. Okay, some said no. Okay, you're correct. So you're right. You see, A lot of things in our life, we have a checklist, but when it comes to investment, we don't, right? Why? The strategy number one is not something special. Create your own investment. Okay. Secondly, do a pre-commitment rules to yourself. For example, I will sell it as at a 15% stop loss, or I will take profit uh at the 25%, for example. And don't put it into your brain, don't think that, I think this stock, I have a 5% stop loss. You think. But when the stock started to drop 5%, more than 5%, your thinking start to change already. Yeah, maybe no problem. Let us move it to 10%, 10%. When it drop more than 10%, you say, okay, 15%, 15%. You see, we often use our brain to keep all these things, our memory, but don't write it down. For example, in your checklist, also put it down. What are your exit criteria? What are your take profit criteria? Okay, put it down. More than 20%, take half profit. More than 100%, take full profit. For example, right? I always have this kind of method. And you know what? In my investment career of more than 12 years now, I have total of 3 stocks that went at least double. That means I have 100% over return for that 3 stocks. And I already have a clear guideline for me. When I want to exit, how much and how to sell. So for all these 3 stocks, I done the same. You see, I done the same. I take full profit out. See, I take full profit. And this is because I have the pre-commitment plan. Okay. And with these pre-commitment plans, it reduces our reaction-based investment and it gives us more control and more discipline. And thirdly, third strategy, keep an investment journal. I know this is very simple, but not a lot of people do. And to be honest, in the past, I also don't do. Until now, I have to do it. Okay, until now, I have to. You know what? Because in the past, I trade a lot of stocks. So to keep an investment journal take time. So I don't like to do. But now because I do investment value investing, I don't trade the stock much. Okay. So I can do it. You know what? Maybe 1 year I only invest 3 times, 4 times. Okay lah. A journal is very simple Three only do 3 times, 4 times. But not like last time. 1 month I can trade, 10 times, 20 times. So I don't like to keep track. But yes, we need to do. So we need to record why you buy, why you sell, what are the criteria that meet, and it helps you also to identify the pattern in your behavior. You see, maybe a lot of shares you take profit at 10%, but at the end it went up 20 to 30%. So you will start to know, or maybe my take profit I can put it at 15% or 20%. See, these are the items that we can always look at. And the fourth one will be to use dollar cost averaging. Now, this is more towards investor. If you are a value investor, long-term investor, yes, this is for you because it will give you an example. It will give you a habit on invest into the market no matter what happens. Okay, but the fundamental must be there lah. If the fundamental is not there, then don't do this. You are averaging down and down and down, and at the end you are making a losses over here. Okay, and what happens? Why we need to use dollar cost averaging? Because it removes the FOMO and also the confirmation bias and all the behavioral bias. It removes all the it removes the emotion from our investment. And last but not least, the strategy number 5 is a partner for accountability. Always look for somebody that you can share your idea with, a friend, a mentor, a community of investors, whoever it is. Sometimes people don't have friends. What they do, they started a Facebook page, Instagram account. They do their own blogging, just to share their ideas because they are looking for accountability. I started I started writing investment blogs since 2019 together with my team, the E Cameron. And that's how we gather more than 1 million views of our contents. Because when we share about our research, we share about our ideas on stocks and what we think about it, people can align with us. People resonate. People can start to comment, hey, this work and this don't, right? So from there, we get a community. we gather a lot of people to come in and to share the same knowledge and same idea on to make a value investment. So that's where we started, and that's where we still doing now. We're still doing content, we're still doing research. Okay, but we don't publish it very often nowadays because of the Security Commission's guideline, right? And why we need a partner for accountability, because it forces us to justify our logic and not just act on a house. So I will just let's just do some recaps over here. So today we've learned about the behavioral finance, investor biases, market anomalies. I give you some case studies, and at the end of the day, I give you the 5 strategies for you to try it yourself in this market. And I hope after today, right, we can all recognize our behaviors, our emotions in doing investment decision, and let us be a better investor after today, right? And my last quote for you is that the best investor are not the smartest, but they are the most self-aware investor. So if you can control your behaviors, you can compound your wealth and reach your wealth target, right? And let us end here for today, right? Thank you very much. I shall call back our moderator, Shane, if there are some of the questions for me to answer. Thank you, everyone.
All right, thank you so much, George, for sharing with us all these behavioral economics and how it affects our investment decisions. All right, so if any questions to ask our speaker, you may write your questions in the Q&A box, not the chat box. All right, Q&A box. Okay, so the first question I see on my screen, I'm not sure if I understand the question correctly, but let me try my best. Okay, so Lik Xuan is asking, so there are many major shareholders who buy and sell and who also conduct direct business transactions, leading institutional investor to buy or sell, and also company to do share buyback. So are these point of consideration for us, or whether should we do investment based on all these kind of information?
Okay, this is a good question from next one, right? Okay, now, when you ask about all this, the what we call the corporate actions, what happened to the shareholders, they do in the market. For me, I will still look at it, but it will not form a lot of my investment decision because I'm a kind of person who do value investing. What matters most for me is the fundamental of the company. If the fundamental, the business, the finances, results speak for themselves, right? So if the finances, the performance is actually doing better and is actually aligned with the company's directions and their future growth, if that kind of fundamentals show to my face, right, all these DBT, the company buybacks actually don't bother a lot for me. So from my point of view, it is not a waste of time because we don't know. Maybe from that you can, you can design and innovated a special formula, for you to identify some patterns, to invest in some stocks. See, but it is not my own investment style. So for me, I will still look at it, but it will not form my investment decision solely based on that because fundamental is the key, right? So that's my answer for you. But for sure, if you think that there might be some patterns from there and you might find a winning strategy from there, feel free to do so. But I doubt that you can do that lah. I doubt lah. You can try lah. You can try. Okay.
All right. So the next question is by Bahari Sulaiman. So his question is, what kind of behavioral biases do people who trade or who like to trade cheap stocks or penny stocks and make big returns?
Okay. When we talk about behavioral bias, we are talking to something that will cause the emotional selling and emotional buying. If okay, from Bahari's question, right? If you are the kind of traders, you often trade cheap stocks, but you have a very good winning rate. For example, 70 or 80% of the cheap stocks that you have identified actually can make bigger returns, or huge returns for you. That's for me consider it's not a bias because you understand how you are aware of the bias that people have on the stocks, right? But if let's say some of the investor, because they look at this price is cheap, okay, so they invest into it thinking that this will go up. And now this is what we call a okay, from the example from the scenario I mentioned, I believe you can start to think what are the bias that I showed you just now, right? The anchoring bias. Because when the price is cheap, they will think that the price is cheap. Oh, it used to be 1 ringgit, but now it's 10 cents, 20 cents. So they have the anchoring bias now. They will go back to 1 ringgit. Now these are the anchoring bias. But if you don't have a strategy, you don't really go and study the patterns. You don't have a formula how this thing actually works, for you to have the criteria. So it meets all the criteria and the share price actually can go up one. If you don't have this kind of criteria, you are doing emotional investment. But if let's say these have been made as the strategy for yourself, then this is not emotional investment anymore. This is a winning strategy for you. Okay, understand? So we need to know how to identify the differences between emotional investment or the money making strategy for ourselves. Okay, I hope I answered for the Bahari's question.
All right. So the next question is by Laura. So she's asking, is investing small will help to reduce behavioral emotions? Good question.
Good, good question. I always tell people start small, because from there you will start to identify what behaviors you have. But unfortunately, uh, invest more will help you reduce it. But when you start to invest more, your behavioral emotion will still amplify because you invest more. Now, this is a very reality kind of question. Why? Because when you invest more, for example, you invest 1,000 ringgit, you have a million worth of portfolio or wealth. 1,000 ringgit is nothing for you. Over here, there's no emotion. Now 1,000 ringgit, okay lah, loss also loss law. There's no emotion kick in. But if let's say you only have 1,000 ringgit, you have 5,000 cash and invest 1,000 ringgit. See, so this 1,000 ringgit is the 20% of your total savings already. So this is where the emotion will come in. So if you ask me, it doesn't matter if you start small or if you invest lesser because emotion will still be there. But we need to identify. So if you don't know your behavioral emotions that will kick in, you can start small first. From there, you identify. After you know that will happen, then you start to control it, be aware of it, and then you write on it. So you can start, after that, you can start to increase your investment amount, because you already know, identify your investment bias.
All right. So I guess the idea of uh, investing is don't really invest with your scared money. Lah. Okay, scared money
Yep.
means the money that you cannot afford to lose, right? So if you invest with your scared money, then chances are your emotion can be amplified. So if you invest with risk capital, which is the amount of money that you can afford to lose, then you tend to make fewer wrong investment decisions. Okay, so when it comes to investing or trading, we don't really want to invest with the money that we cannot afford to lose because chances are we're going to make a lot of bad investment decisions because these are the money that we cannot afford to lose. Okay, so the next question is how do we identify uh, a buyer stock before it takes off? This is by Harris. I'm not sure if I understand your question.
Okay. I think Harry's question is how do we identify a stock if they have been driven by buyers? So before it take off for us to actually write on the buyers, right? The answer is no, we don't, Harry. uh, we actually can identify what kind of buyers in the market, but we can only identify when they already happen or they are happening. So if you want to structure your winning strategy based on identifying the biases that will happen to the stock, I can assure you, you better don't do that because uh, this is just like you are trying to be the professional X. You are trying to know everybody's how they think. But the truth in real life is that we don't, right? We don't. So rather we go and study how people think, better we go and study how this company works. Because facts and figure is easier for us to do research and analyze than the human being. So my answer to you is that don't identify the bias stock, but we study on the fundamental itself. Right, I hope I answer to Harris. Okay.
All right. Thanks, George. Um, let's do one last question. This is by Maha Lingam. Um, so the question here is, I do follow some stocks during their quarterly results, and there are some stocks who earn double-digit profit growth, and the share price has already increased 30 to 40% before the result came out. And after the result came out, the share price started to drop after that. So how do we know this early and not to get trapped if you just buy on post result or post earning announcement, right? What's your view, George?
Okay, let me study again. Maharingam, right? Okay, some stocks, their quarter performance earn double the profit and the share price already increased, right? Um, okay, this is very simple, Maharingam, because the result is actually a lagging indicator, right? For example, my quarter result of Q1, I released now in May, right, or June. Okay, this is basically what happened, right? So when the market is doing well for the industry, the smart investor, researchers, economics, they have already studied on it. So they know now these companies usually they will do well. Like I think Eugene you just mentioned, right? The results is usually priced in. Now, what we don't really know is that these are all not perfect information because these are based on our own studies. If you think that okay, now this stock the profit will roughly rise by 20%, 30%, and suddenly it just exceeded your expectation. It went up 30 to 40% in the profit in the earning per share. Then the share price will up. But oftentimes the share price don't up. Why? Because um everyone, for example, if they already, foresee and they have done their research in a market like this, and I can assure you, this will continue to happen. Because what? Because now a lot of people started to understand the value of investing. They started to understand the importance of doing research. So when a lot of people started to do research and you don't, then they will started to buy the share before it went up. And after that, you only come in. You see, now this is very important. To understand how value investing works, understand how to do valuation, so you can be part of the group of people who find and identify the stock before it went up. This is very important.
All right.
Okay.
Thanks, Josh, for sharing your idea about behavioral economics and for addressing the questions that we have on our panel. So unfortunately, we don't have any more time for the Q&A, so we'll just conclude the session here. So, ladies and gentlemen, you just listened to the co-founder of EE Cameron, who is Mr. George Poh. Thank you so much, George.